Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger Associates Financial Planning. I am pleased to have Ryan Keefe as my guest, if that's the right word, or co-host. Ryan is one of my associates, and congratulations, Ryan, for he's my most recent CFP. He just passed his CFP. Congratulations.
Thank you.
So anyway, with our firm, we believe in financial planning, and with that, most of our advisors are certified financial planners or will become certified financial planners, and that's something that we believe in wholeheartedly with our firm, as well as education. We believe that education and knowledge are powerful, and we strive to provide an educational experience for all of our clients as well as you, the viewers. So what we're going to be talking about today is after-tax deferred accounts, okay? And we're going to be bringing up slides that we've used before several times, but all comes down to taxes. It's not how much you make, it's how much you keep. And what we're looking to try to do is kind of define more exactly how some of these accounts work. So really what we're going to be talking about, of the 6 areas of financial planning, we're going to be talking about tax planning and retirement planning, I suppose you can argue, because they're retirement accounts. All right, you ready to go?
Let's do it.
Cool. So we're going to be really focusing on deferred accounts, but specifically after-tax type of retirement accounts. And the two types are tax-deferred and tax-deferred, along with my two favorite words.
Tax-free.
Right, exactly. So let's talk about our buckets. We talk about our buckets all the time, in that basically there are 4 areas with which you can have your money. And in the eyes of the IRS, they view it on 3 different time horizons. Going in, as you go, and then when you take the money out. And the first bucket is the only bucket with which you can get a tax deduction. It's your 401k, IRAs, pensions, SEP IRAs, 403Bs, which is the equivalent of a 401k, but nonprofit organizations. You see them a lot with hospitals, teachers, and things like that. And pensions. Okay, well, you bet bottom dollar the companies get a tax deduction when they're contributing to your pension.
Absolutely.
So the way these work is you make a contribution, it's a tax deductible contribution. So for instance, if you make $100,000 and you're contributing 10% of your income, which is $10,000, well then at the end of the year you get a W-2 that says you made 90. Effectively, that was tax deductible. Or if you don't have a retirement plan and you make $100,000 and you contribute $7,000 to your IRA, there's literally a line item on your tax return that says you get to deduct that $7,000 for your IRA contributions. SEP IRAs are IRA type of programs that are for self-employed, generally self-employed, and what they do is they can contribute a flat percentage but across the board. So if I had a SEP plan for my company, which at one time I did, if I wanted to contribute 10% for myself, I have to contribute 10% for everybody else inside the company, inside the plan. That's typically used for self-employed individuals who don't have employees, because if I wanted to contribute 20% to myself, which is the max, I may not want to contribute 20% to whoever the staff are. So, but anyway, they exist out there. Mm-hmm. The second bucket is non-qualified because it's a non-retirement. It doesn't qualify for any specific tax advantages. Your savings accounts, your regular investment accounts, real estate, stocks, bonds, mutual funds, whatever inside regular investment accounts. What happens here is that when you put the money into the account, you're not getting a tax deduction. Similarly, you take the money out, you don't pay the taxes on it. But what happens is that you pay the tax on the interest and dividends and growth, your growth if you sell it, meaning in the form of capital gains. So you put $10,000 into your savings account, you're earning 5%. At the end of the year, you're going to get 5%, which is $500. You're going to pay tax on the interest. But if I wanted to grab my 10 grand, no tax.
Right.
Okay. And as far as capital gains go, if I bought a stock for 10 grand or an ETF or a mutual fund or some type of investment, I buy it for $10,000. If it grows to 15 and I sell it, I have to pay taxes on the $5,000. And of course, they differentiate between short-term and long-term, which is over a year is long-term, and you get special treatment. The focus of today's episode is going to be about the after tax, which are the next two buckets. The next bucket is after tax 401ks, non-deductible IRAs, and non-qualified annuities. Same token, you contribute $10,000 to this particular account. It grows to 15. That $5,000 is tax deferred, and when you take the money out, you don't pay tax on your original 10, but you pay tax on the 5. We're going to be spending a lot of time on that because each of those three different types have different nuances as to how it works. And then lastly, kind of my favorite bucket, is the Roth IRAs and the Roth 401ks. And in that particular case, you make the contribution, it's not tax deductible, it grows tax deferred, but it comes out again to my two favorite words.
Tax-free.
Tax-free. All right, so let's talk more about this. And by the way, the only ways you can get money into that bucket is with the Roth IRA and the Roth 401k, you need to be working. So with the Roth 401k, you think about it, you got to be working to have a 401k. And then your company needs to have the Roth option, okay, which is relatively new. Most companies have it. And if they don't have it, quite frankly, somebody's asleep behind the wheel.
Yeah.
You know.
And with today's tax laws, you can't go wrong with going with the Roth IRA if you're under certain income threshold.
Correct. And again, under certain income thresholds, but you have to have income in order to contribute. So the third way, which we've had plenty of discussions on, are the Roth conversions, the Roth IRA conversions, where you take money from either traditional 401k, convert it to the Roth 401k, or you take money from the IRA, convert it to the Roth IRA. You pay taxes at today's rate, which means you're including it on your tax return, and then it grows tax-free for the rest of your life. So again, we're going to talk about those last two buckets, and that's the focus of our discussion today. All right?
Sounds good.
So, again, we talk about the tax-deferred accounts. You got the non-qualified annuities, the non-deductible IRAs, the after-tax 401k, and the Roth 401k and the Roth IRA. So let's talk about the after-tax ones now. You want to pick it up, or you want to let me talk the whole time?
Sure. So I guess we'll start with the non-qualified annuity.
Yeah.
Where we see a lot of these products out there. Basically, you can. What is an annuity? Annuity is you take a portion of money, you give it to an insurance company, and they're guaranteeing you a stream of income for the rest of your life.
If you take it out that way, but there are people who use it as an investment vehicle, at least until you take it out. Serving as an investment vehicle, this is what we want to discuss from the tax perspective. But go ahead.
So let's say you give the annuity company $100,000. That is essentially your cost basis, and they invest it in a bunch of different investment vehicles, usually mutual funds. Then let's say you have growth on top of that. That growth sits on top of your cost basis, and whenever you go to make withdrawals, it comes out as last in, first out, or LIFO in our industry. And you're paying ordinary income taxes on the growth.
Right.
And until you get back to your cost basis, which is all after-tax money, that you can pull into and not pay any tax or penalty on.
All right, to clarify a statement that Ryan made so that compliance doesn't yell at us and scream at us and tell us to edit it. A annuity does not hold mutual funds. They're what's called separate accounts, which behave similar to mutual funds. Point that out.
Yeah, fair enough.
They also have a variety of different options. They have what's called fixed annuities, where it's a fixed interest rate, has similar characteristics to CDs, and they also have index annuities, which enabled you to put money into a particular index, and worst case scenario, you remain flat, doesn't go down, kind of gimmicky, but if it goes up, you pick up whatever the index, sometimes to a cap. But again, annuities work the same way. They're through an insurance company. To Ryan's point, you put $100,000 in and it grows tax deferred. And tax deferred means that if it grows to $150,000, you're not taking and paying any taxes until such time that you take it out. And we'll talk about that later.
So then you have the non-deductible IRA, which, as most people know, you have a traditional IRA. You make a contribution to it as long as your income is below certain thresholds, where if you're single, it's $77,000, and if you're married, it's $146,000 or $123,000, of income or modified adjusted gross income, that gives you the tax deduction. If you want to make a contribution to an IRA and you're above those thresholds, you're allowed to make a contribution. You just don't get the tax deduction for it.
Right. That's correct. And what you're doing, you're going to notify on your tax return. I think it's Form 8606. But what happens is that effectively, if I made a $7,000 contribution to an IRA and I can't deduct it, it's still reported on the tax return as making a contribution. But now I have $7,000 in my IRA that is considered cost basis. And as it grows,
Right. And the growth is, considered, or it'll be ordinary income when you pull it out.
it remains in the account, much like the other one. And then the last one,
And then we have the after-tax 401k. Essentially kind of operates the same as a Roth 401k, except that the growth is also taxed at ordinary income rates when you pull it out. But there are certain strategies that we can get into with that, where you can actually roll it into a Roth IRA and effectively do sort of a Roth IRA conversion.
right.
But essentially, the growth remains a pre-tax, and you have the after-tax portion, which you've already paid taxes on.
Right, and we'll talk about the differences between these because each of these basically work the same way. You got a cost basis, and then there's a growth portion of it that is considered to be taxed as ordinary income. It's the withdrawals that differ between the three, okay? So now let's talk about the Roth. Same concept.
Right.
Put the money in, and then you have a growth piece.
Right, but this growth piece is tax-free.
Right,
As
exactly.
long as you meet two criteria.
Right.
And those two criteria being you must be age 59 and a half or older, and the account has to be funded for at least 5 years.
Right. Now, little not commonly known nuance is if you are contributing to a Roth 401k, your 5-year time clock does not start until you open a Roth IRA. So we've had this happen before where we knew the client was contributing or had been contributing to his Roth 401k, but what we did on the outside is we did a Roth IRA conversion for $1,000 just to initiate and start the Roth IRA so that when he retired and rolled over his 401k, the Roth piece went in
Right.
and the 5-year time clock had already been started.
And you can always, one thing that I get asked a lot from clients is, if I contribute to this Roth IRA, what happens if I pull out the money early? If you pull out any portion of growth and you're under age 59 and a half, you're going to get hit with tax and penalty. However, your contributions are always tax and
Right.
penalty free.
Because it's after-tax money that went in. So we're going to take a break right here, and what we'll do is we'll pick up when we come back on the different nuances between the after-tax 401ks and the non-qualified accounts. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we are talking today about the differences, most notably about after-tax contributions to retirement accounts. We've certainly talked about the Roth IRAs. They're always beautiful. So let's go back to our buckets real quick. This is where we show the different areas with which you can contribute to a retirement, or basically any type of account, and how it's viewed by the IRS. We are focusing on the last two buckets, but really we know that the Roth IRA and the Roth 401k grow tax-free. So what we want to do is talk about the differences between the three pieces within the tax-deferred bucket. I generally will come out and say, I can't stand this bucket. But unlike other people, I never say never and never say always. So herein lies, there are times, even though I hate this bucket, there are times when this bucket works. And we're going to talk about those times right now. So the tax differences between the three, again, we talked about. With the non-qualified annuity, it's LIFO, last in, first out. Remember, anytime that you have any retirement plan where you're drawing the money prior to age 59 and a half, you're subject to a 10% penalty unless you meet criteria like death and all that. Let's go away from that. Death and disability and things like that, okay? But the thing that I hate most about non-qualified annuities is the LIFO treatment,
Right.
okay? So I've come across this before where an individual had a $240,000 annuity that I met, and their cost basis was $100,000. And the problem is they can't even get to their 100 until they burned through the entire 140.
Right.
So, if they wanted $50,000, LIFO, last in, first out, which means they're basically drawing it from the top down.
Right.
And there was a sneaky thing that I was able to do with them, which is very uncommon. But what I did is they wanted to be able to get $100,000. And the way it was situated is they would have paid tax on that entire $100,000, which would have also pushed other things. It would have just been a disaster. What we did is we did a partial 1035 exchange. Okay, it's sort of beyond the scope of this, but we were able to get it out and slice it and make it so that they only paid tax on a certain portion of it, but that's beyond the focus of today.
Right, and a lot of times when people are buying into these annuity products, they're unaware that there's also a surrender charge associated with them.
Right.
Which generally is 7 years.
Yes.
Some are shorter, some are longer, and those surrender charges can really eat into your principal if you decide, I don't want to get into this product.
Yeah, I goofed.
It's a shame, but that's you want to be cautious of that when and really understand what you're buying when you go to purchase any product really, but especially.
Well, yeah, and the thing is that it's often sold as a wonderful thing. Tax deferral is wonderful. Baloney. Okay, I can tell you every way since Wednesday why tax deferral is actually not good, and how you're probably better served. Again, in most cases, there are rare cases if somebody's in an extraordinarily high tax bracket now and knows in a few years they're not going to be. That was the one time in my 25-year career that I sold a non-qualified annuity because it made sense for that individual.
Yeah.
Okay.
Yeah.
Once in 25 years.
That's why you can't say always or never.
That's right, because it made sense in that particular time, okay? Once in 25 years. So the non-deductible IRA is similar, except that it comes out pro rata. So what that means is if I put $7,000 into a IRA where I didn't get a deduction and it grows to 10, what happens is if I wanted to take, let's say, $2,000 out, it actually slices it down pro rata, whereas in this particular case, my $10,000 after-tax 401 or after-tax IRA, 70% of it is cost basis, which I don't pay tax on. So if I wanted to take $2,000 out, then 70% of that $2,000 is tax-free, which would be $1,400, and then the remaining $600 I pay tax on. But the problem is then you need to track that, because now that I took $1,200, 14 or whatever number I just said, $1,400 of cost basis out, now my cost basis went from $7,000 to $5,600, and that needs to be tracked on your tax return forever. Okay, I don't like them for that reason.
Yeah. Really, the only time I really like the non-deductible IRA is when we're looking at doing backdoor Roth.
Right, and you're jumping ahead.
I'll stop him there.
No problem. No, we're going to be talking about the advantages and disadvantages. And to his point, yes. Go ahead and finish that up. I mean, you could go ahead.
So the backdoor Roth is a fairly well-known concept where if you make too much income to contribute to a Roth IRA, and I actually wrote it down here. If you make $146,000 if you're single, or $230,000 as your modified adjusted gross income, you are ineligible to contribute to a Roth IRA.
Right.
That's actually the beginning of the phase outs, but I won't get into all that. So if you're ineligible to contribute to a Roth IRA, what can you do? Well, you can make a non-deductible contribution to an IRA, which we specified earlier. There are no income limits for it. You make the non-deductible contribution to the IRA and immediately convert that to a Roth IRA. And essentially what you're doing is taking money that you've already paid taxes on and contributing it to the Roth IRA.
Right. So to be clear, we just referenced earlier the pro rata rule. If I was taking $2,000 or 20% out of my account and taking it out, I don't pay taxes on the piece that's cost basis. If I contribute $7,000 to an IRA that's already, call it 93, so now it's 100,000, and I do a $20,000 conversion, only 7% of it is considered to be a tax-free conversion. I have to pay taxes on it. So the pro rata rule continues over. Now, so therefore, if you already have an IRA, then the backdoor Roth conversion probably doesn't work for you.
Right.
You do it when you don't have an IRA, because then if I contribute $7,000 and flip it immediately, I'm taxed on the growth. But if there's no growth, therefore it works. Now, we're doing one right now.
Yeah, right.
We're adding $8,000 to a $130,000 IRA. Why? Because we're going to convert the 130 anyway.
Yeah, exactly.
And they didn't qualify for doing a Roth contribution, so we said, hey, let's do a contribution to your IRA. We're doing one for last year, one for this year. Flip them all, boom, done. And we convert the whole darn thing, which we're going to do anyway. They're only paying tax on the growth piece, or the piece that was the IRA anyway. After-tax 401k.
So the after-tax 401k, the first thing that I'll say is you want to make sure that your plan offers it.
Right.
Because if they don't offer it, then
Not an issue.
it's not an issue. But essentially what the after-tax 401k is, with most plans, is once you reach your maximum contribution limit, which is $23,000 for this year, unless you're over age 50, then you get the extra $7,500 in catch-up. So once you max out your $30,500 contribution to either the pre-tax or the Roth, you're able to actually go up to, I believe it's $59,000 or $76,000, including the catch-up, in after-tax money. But what you want to be careful of is company match that can reduce that number.
Yeah, I think those numbers aren't right. I believe 69,000 is the max. So you back out the 7,500 or something like that. But you got the idea is there's a cap as to how much you can do. And what's important to understand is, you can contribute those monies that are after tax, but the way it works inside a 401k is that if I contributed $10,000 of after tax, all of the interest and the growth on that $10,000 spills over to the traditional bucket, period. Okay? And there's no pulling it back. So we typically do not encourage contribution to the after-tax 401k simply because it's growing, much like the annuity, it's growing on the ordinary income side. However, there are two occasions that we'll do it. Okay, we'll do it where if a company matches, number one, you don't want to burn through all of your $30,500 or the $23,000 and then not get match. You want to make sure that the company matches the after-tax, for one. For two is, do they allow in-service Roth conversions? If they do, then what you do, it's referred to as the super Roth.
The mega Roth, mega backdoor.
Mega backdoor Roth, okay, or super backdoor Roth. So what you can do is, if your plan allows for the conversion inside, which, by the way, we're establishing our plan to allow for after-tax contributions, subsequently followed by in-plan conversions. So therefore, I can contribute and supercharge it and then immediately take my after-tax and transfer it. And guess what? I just created a Roth IRA.
Right.
Okay, just like the backdoor Roth, I just created a Roth IRA. Okay, although it's inside my plan. But now, then all of my after-tax contributions got flipped to the Roth, so any growth from there grows in my two favorite words.
Tax-free.
Okay, so the other example that I'll do it is, there are companies out there, one in particular, we have a handful of clients, one is retiring next year. They continue to match on catch-up. Since I can't stand the after-tax piece growing, I'm sorry, not the growth on an income basis, what I'm doing is he's retiring next year. So because he's retiring next year, we're jamming it at the end of this year and then next year, at which point it gives us the ability to convert the whole kit and caboodle, which is basically going to be about $30,000 extra this year, $30,000 extra next year, and the client will then be able to effectively create $60,000 of Roth contributions because we're going to immediately convert it in the plan and next year. No, actually, that plan does not allow in-plan conversions, which is why we're waiting until the last year before retirement, because the only in-plan growth that he's going to have is whatever it grows from like Q4 of this year to the time that he retires in May of next year.
Okay, right.
So let's talk about the advantages and disadvantages to close out this particular episode. Again, the disadvantage of these types of plans is, for instance, the non-qualified annuity is it's ordinary income.
Right.
You know, we could take the same $10,000, put it into a stock type of ETF or stocks or something that spits out dividends.
Right. And you're getting capital gains rates.
Right, and dividend rates.
And dividend rates.
Right, which is always lower than, all right, never say always, because zero is not higher than zero
Right.
if you're in a 0% tax bracket. Okay. With the exception if you have no tax, the tax rates are always lower for capital gains than they are. So we prefer not ordinary income when possible. The other issue is unwinding non-qualified annuities. And I refer to that unwinding. I used that example before where I ran into somebody at 100,000 that grew to 240. Man, that is a problem, unwinding those things, because your first 140 is you're paying ordinary income, and if you don't do it all at once, guess what? You take $50,000 out, and it continues to grow tax deferred. Look at the one client that we had that had the money with the one annuity. Okay,
Mm-hmm.
you probably know who I'm talking about.
Yeah.
Last name starts with an S.
Yes.
And so what we were doing every year is we were trying to unwind the non-qualified annuity to take a few $1,000s out. It took us about 7 years to get the money out of the annuity to the point where she no longer had that growth in there. Right. You know,
And there's, if with people with a large growth piece to their non-qualified annuity, that actually presents a pretty substantial estate planning problem.
that is
for the
correct.
beneficiaries.
Because what happens is the beneficiary gets taxed all at once, which isn't fun either.
No.
You know, there's 3 winners here: Mr. I, Mr. R, and
Mr. S.
Mr. S. That's right. And we don't like him. We don't like those 3 guys. We talked about the effective use of the after-tax 401k is if there's the ability to do in-plan conversions,
Right.
as well as if someone's nearing retirement, if they don't have the in-plan conversion, if they're nearing retirement, then when they roll out their 401k to an IRA, all after-tax money goes into a Roth IRA,
Right.
or can go into a Roth.
And it might seem pretty obvious at this point, but I'll just state it because I've had several clients ask me it before. The Roth 401k is not the same as the after-tax 401k. Very different.
That is correct.
Very
It's
different.
after-tax money that goes in, but they are not the same. So thank you, because to point that out, when you're, a lot of times, and I think Fidelity is one of them, a lot of the 401k providers, you go online and it gives you the choice: traditional, after-tax, and Roth. After-tax and Roth are not the same thing. You want to make sure that you look at your company's summary plan description to A, make sure they match all the way through, and secondarily, you want to contribute to the Roth before the after-tax. That's a no-brainer, because you know it's growing tax-free. And then, we talked about that. The Roth IRA contributions are always liquid, and they're tax-free if the entire Roth is tax-free if you're
Right.
over 59 and a half and over 5 years. So anyway, those are the differences between all the different after-tax type of accounts and utilizing them the best way. So if you have any questions, feel free to reach out to us. Ryan, thank you for chipping in all 30 seconds of this episode. It's my fault for taking the whole thing. But anyway, thank you very much for joining us today. I hope you learned something. As always, Thank you for joining us. And I'm Mike Menninger signing out from Financial Planning Explained. Thank you very much for joining us.